Hi guys, a very good evening to all of you all. Hopefully all are staying safe and healthy, right? So today what I have planned on to do is a March-June 2022 paper, right? Luna Code. Okay. So our previous session was all about ethics, right? I have recorded another two videos on ethics which will be uploaded within this week, right? Onto your Google Classrooms as well as YouTube, right? Instantly. So the reason I'm again jumping into consolidation would be simple, right? I don't want to make yourselves bored as well as mine, right? So what I thought of doing was, let me do three questions of consultation. After it, let me do three questions of ethics, right? And after that, if there is time, let me start attempting question number three, right? So by me diversifying my way of practicing, right? By me diversifying my way of practicing rather than focusing on only consolidation, or rather than me only going on focusing my entire week on ethics, right? I would like to diversify. So that would keep me motivated for me to practice more and more papers, right? Not only myself, I want you all to follow this as well, right? Don't try to do one particular set, or don't keep your mindset focused on one, right? I'm only going to do for this entire week or for this entire day consolidation. No, right? Make sure try to, try to go and look into other areas. There is ethics, right? There's question number three, there's question number four. Don't attempt question number four for now because that has some current issues, right? Which you all are not aware of. So I'll tell you all when to attempt. Until that, I would want you all to attempt question number one, question number two, which is ethics, question number one, which is consolidation, and question number three, right, which will have multiple standards. Okay, so if you all are done with your standards, if you all are done by watching your recordings for your standards, right, you all can start attempting these three questions. Okay, always try to diversify. Okay, so it's 10:56, right? When you look at this requirement, right, it's quite a lot, to be honest. It's quite a lot, right, for a 30 mark. It's quite a lot. When I did it personally, even I had a mini attack. Why is the examiner testing with this? But as you all know, this is a September, December 2022, right? After 2023 or 2023 onwards, examiner has started creating something known as the pre-populated sheet, right? And his way of approach of testing y'all has totally changed, right? What he always wants y'all to do now is, after 2023 approaches, he wants y'all to explain rather than calculating a lot, right? Which will save y'all a lot of time, right? And he has not given you, I mean, after 2023, you all will see, right? If you go through the past paper analysis, you all will be able to see, right? He has made the paper quite simple. Not simple, I would say the paper is a bit, more lenient, student friendly, right? So you all do your analysis, you all itself will be able to know. See, rather than breaking it into multiple or substandards again and again, right, into sub requirements again and again, what examine has done is he had made it in a quite simple manner after 2023 onwards, right? That's all you all need to know. So without wasting further time, it's already 10:57 here. Let us start doing your question. Okay. So always, as usual, I'll go and read out the background information and identify the current financial year, which is 2006 March, right? And after then I go and move on to our requirement, right? I'll go and move on to our requirement. Okay. So today, I guess, guys, I'll try to finish off a requirement, right, which is about 17 marks, and I will upload another video which would be B and C in another session. The reason would be is I don't want y'all to fill y'all with much and much of explanations and YouTube videos and Google videos. No, because you all will get fed up at the end of the day. Because always quality is more important than the quantity of that y'all are going to attempt. Right? Always make sure that y'all are able to grab in. So in order to do that, what I would like to do is I will break. I'll try to finish off the entire A part today, and after it, I'll be uploading another video for your B and C requirement. Right? That would be ideal. That would ensure that the quality over the video, right? So that you all are able to understand. Okay. So our very first requirement in terms of A would be, right, they want us to explain and they want us to calculate. right? What do they want us to explain and calculate? They want us to show some accounts, right? They want us to show some accounting treatment in terms of disposal of shares. So what they have gone and done is, right, they have gone and disposed some shares. Okay, they have gone and disposed some shares. They want you all to only simply explain and calculate how do you all do the accounting for the disposal of shares. That's all they you all need to do, right? That's all that you all need to do. Okay, if you all explain, if you all merely explain plus include calculations, right? This entire 7 mark is yours. This entire 7 mark is yours. Be positive, right? Be positive always, right? You will be able to get that entire marks. Okay. And also they are requiring consolidation financial statements, right? They are not specifically mentioning SOFP or they are not specifically mentioning SOPL, right? They are telling you all they are giving it in a common basis. So if you all find any answers that is relevant to SOFP or SOPL, make sure mention it, right? Because examiner's marking scheme is quite lenient. You will be able to grab that mark. Okay. So before attempting or before reading the exhibit number 1, I would like to show you all the marking scheme. Right? I would like to show you all the marking scheme. Here it is. Here it is. Right? The marking scheme is examiners allocating for calculation maximum of 3 marks and for your explanations, right? Detailed explanations, 4 marks, right? That's how your 7 mark is comprised of. Okay. So now let us now if I need to explain and calculate of for the disposal of shares, I need to go and read exhibit 1. I need to go and read exhibit 1. So let me start. Let me start. Let me take multiple color pens here. Take multiple color pens here. Okay. Lunaco acquired 80%, right? When did they acquire 80%? On 1st April 2002. And who did they acquire? They acquired a company named as Starlight. Obviously, you all know when you all are acquiring 80%, you all are parent and Starlight is a subsidiary. This I don't need to go speak in detail. Right? When they're acquiring on 1st April 2002, which is 4 years behind, your current financial year, right? So it's 4 years back, you all have gone and acquired. Okay. How many number of shares you all have gone and acquired? You all have gone and purchased 1 million shares, right? So this 80% is equals to 1 million, right? Or 80% is 1 million shares, right? 80% is 1 million shares. Okay, you all have gone and purchased 80%, right? Or 1 million shares you all have gone and purchased in total, right? On 1st April 2002. Moving on, okay. And after that, you all have not issued any shares for many years, right? So I guess after that, you all there was no need for you all to go and issue shares, right? That shares has been remaining at 1 million, right? Okay, you all did not go and issue any shares. Okay, goodwill on acquisition was correctly calculated as 320,000. Okay, 320,000, fine. But subsequently has been impaired by 15% in 2004. So what do they mean is, obviously you all know, right, when you all are calculating or when you all are being a parent, right, at the date and at the date when you all are being parent, or at the date when you all acquire another subsidiary, right, when you all acquire subsidiary which is more than 51%, you all need to start consolidating, as well as you all need to start doing goodwill calculation. Goodwill calculation is only done at the date of acquisition, right? Goodwill calculation is done at the date of acquisition, right? So ideal they would have gone and done on 1st April 2002 a goodwill calculation, right? And that is totally correct, right? Examiners have already correctly calculated it as 320,000. So we don't need to go and calculate goodwill again, right? That's already done by the examiner. The only thing that the examiner did not do in terms of goodwill, the only thing that the examiner did not do in terms of goodwill is there has been an impairment, right? There was an impairment of 15%. He has not gone and adjusted. He has not gone and adjusted. That is why they have told they have bought in, but had subsequently been impaired by 15% in 2004, right? You all purchased on 2002. After 2 years, you all had an impairment of 15%, right? That was not adjusted. Okay, so you all need to go and adjust it. Okay, you all need to go and adjust it. Okay, so I would tell you all, let me give you all a hint here. So, goodwill at nature, right? At nature. This should be more than enough for you, right? I'll give you all pin pointers. I'll give you all pin pointers here and there so that you all don't need to confuse yourselves. Okay, and after that, Lunaco values the NCI at fair value. Okay, fine. Fine. Fair value. I guess why he would have bought that is examiner silent is because he bought impairment, right? So impairment, if it's fair value, we need to give it a particular share has to go for parent, a particular share has to go for NCI, right? I guess that is what he's trying to indicate. Let us read on to identify. Let us read on further. Okay. The fair value, the fair value of net assets of Starlight Co. Right. So what they're telling is the fair value of the subsidiary, the fair value of the subsidiary at the date of acquisition, right, exceeded their carrying amount by 200,000. Right. Now this is our very third question or fourth question in our consolidation. Right. By now you all would have tried to identify what is this particular adjustment. Right. What is this particular adjustment? Right. What is this particular adjustment meaning? Okay. Whenever you'll see your fair value is more than your carrying value, right? The fair value that is sold in the market is more than your carrying value, right? That indicates upward adjustment. That indicates upwards adjustment, right? Upward adjustment. That indicate upward adjustment. Why it indicates upward adjustment? See, let me bring in a small example soon. Let me be soon quick. Now this is my second time or third time I'm explaining, but no problem. What would have happened is, see, you all know Kit Kat, right? Kit Kat. Uh, in the supermarkets, it's being sold at 200 rupees, right? Or $200. Kit Kat is being sold at $200. But in your particular company, which is the Starlight Co, right? In your particular company, you all are selling at say about $150. You all are selling at $150, right? So a common question that I would ask from your is, when the entire market, right, when the entire supermarket, when the entire hypermarket is being sold at 200, why are you all selling at 150? Why are you all selling at 150? Right? The market price, the global market or the regional market price is 200, right? Why are you going and selling at 150? Right? That's totally absurd. That's totally irreasonable, right? That is why you all need to go and do something called as upward adjustment, right? What does this upward adjustment do, right? It will again bring it into the actual market price, right? It will bring into the level where all the market prices are being sold. Or I would simply tell that it would be bringing you all into $200, right? From 150 to 200. That is why I call it upward adjustment, right? Whenever your fair value is greater or whenever the market fair value, let me again specify, whenever your market fair value is greater than your carrying value, right, then you all need to do something known as upward adjustment, right? You all need to do something known as upward adjustment. Okay. This upward adjustment is related to a non-depreciable land. Okay, it's related to a non-depreciable. Why they would have bought in non-depreciated, or why they would have told us specifically a term known as non-depreciable. Obviously, land you all don't depreciate, right? Whenever you all do upward adjustment, I guess I did one question with y'all. You all need to do whenever there's an upward adjustment, right? That upward adjustment would create something known as excess depreciation, which you would have learned in FR, right? So since this is a non-depreciable land, or this is merely a land, right? Land does not depreciate. You all don't need to calculate excess depreciation. Okay, you all don't need to calculate excess depreciation. No excess dip. right? I'm giving out pointers, right? I'm giving out here and there pointers. You all don't need to calculate excess depreciation because it's a non-depreciable land. Okay. Now comes the main part. Now comes the requirement. Or now we are coming into our requirement, right? Why? Our requirement wanted to show the accounting treatment for the disposal of shares, right? That is what now we are going to do. Okay. On 1st January 2006, right? I guess it would be in the current year, the mid-year, right? I would call it the mid-year. It's not at the year beginning or it's not at the year end. It's on 1st January, which is the mid-year, right? They have gone and sold 100,000 shares, right? For $7 per share. So obviously they would have got cash proceeds of 100,000 shares into $7 per share would give you all 700,000 cash proceeds, right? That is, leave it aside. Okay, let us leave that aside. Now I guess I have read a lot. I have read a lot, right? I've read a lot. Let us start structuring answers. Let us start structuring answers, and after when we move on, we might be able to read and extract whatever the information that is there or that is containing in these remaining three lines, right? Always don't go and read the entire paragraph, guys. Always don't go and read the entire paragraph because, to be honest, you all will be exhausted, right? You will be exhausted. So read whatever that is relevant and start writing. Start writing. Now, after when you all want, again go back and grab in some points. Okay. So here it is. Here it is. Initially, I bought 80% shares, right? 80% shares were 1 million shares, right? 80% shares were 1 million. The reason I'm telling 80% shares is 1 million is, have they told, right? Have they told, has the examiner specifically mentioned something called as you're purchasing 80% of 1 million? No, right? He's not bringing this particular off, right? He's not bringing this particular off, right? If it was 80% of 1 million, obviously then the share amount that you all purchase is 80, it would be 800,000, right? If he has mentioned off, right? But simply there is no off there, right? You all only need to consider that you all are purchasing 80%, which is equivalent to 1 million shares, which is equivalent to 1 million shares. Okay, so you all purchased 1 million shares, which was equivalent to 80%. After it, you all sold out, 100,000. You all sold out 100,000, right? Out of the 1 million shares, out of the 1 million shares. So in terms of percentage, you all will be getting 10%, right? And after you all sold, after you all sold, right? After you all sold, you all had 70% of control, right? You all had something called 70% of control. Obviously, right? Anything more than 51% is controlled. Anything more than 51% is controlled. Okay, so you all will be having something known as control. Okay. So my very first question to you all would be, my very first question to you all would be, sorry, my very first question to you all would be, have you all lost control or not? Right? Have you all lost control or not? Right? Initially, all were at 80%. Right? Initially, all were at 80%. Now you all at 70%. Have you all lost control? No, right? You all have not lost control. You all were 80%. You all sold 10% only. So because of that, you all at 70%, and you all have still not have lost control. So when you all don't lose control, right, you all can carry on with your consolidation. You all can carry on with your consolidation. Right? You all can carry on with your consolidation. When you lose control, when you lose control, when you lose control, right, at that date, you all need to stop consolidating your accounts. You all need to stop consolidating your accounts when you all lose control. But in this particular question, you all have not lost control, right? So you all can start doing your, you all can carry on with your consolidation. You all can carry on with your consolidation. So my first point would be, guys, my first point would be, right, I would simply mention, right, they sold 10% of their shares, right? Let me only point out the important points, so that would only the important points would be, right? They sold off 10% of the shares, right? And after selling that also, they still had control, right? They still had control. That is an important point that you all need to mention. After selling 10%, did you all have control or not? Is your very first question you all need to ask yourselves, right? Is your very first question you all need to ask yourselves, right? So we have identified that yes, it's a 70% because of that still control remains, right? So therefore, we can start, or we can continue with our consolidation of P&L and SOFP, right? We don't need to stop. We don't need to stop consolidating. Why? Because we are again now after disposing of the 10%, we are still at 70%, right? We have not lost control, right? We are still at subsidiary level. Therefore, we can still continue consolidating our P&L and SOFP, right? If you all include that, that would give you all 1 mark, right? Don't need to don't need to write according to my answers, right? Don't need to write according to the examiner's answers. As long as your individual answers have relevant points, you all will be able to get your 1 mark, right? But I'm only just giving out pointers. I'm only just giving out pointers, right? But but do you all see something is happening? Do you all see something is happening? Do you all see something is happening? Earlier, right? Earlier, you all were at 80%, right? Parent parent was at 80%. NCI, NCI, or the party that cannot be controlled was 20%, right? Now what happens is, now what happens is, now what happens is, now what is happening is, parent has gone to 70%. Where do you all think that remaining 10% would go? Where do you all think that remaining 10% would go? Where do you all think that remaining 10% would go? Where do you all think that remaining 10% would go? Obviously, that 10% would go to NCI. Obviously that 10% would go to NCI because only those two parties only are there in your company, right? Either it's the parent or either it's the NCI. So where do you think that remaining 10% would go? It would go to NCI, right? So this would be 20%, right? And a plus additional 10%, right? And your parent from 80%, it went on to 70%, right? Your parent was 80, he went on to 70. On the other hand, on the other hand, your NCA was initially 20%. After it, he increased to 30%. Why? Because we sold our shares. Okay, so you all need to mention that. You all need to mention that. Here it is. However, due to the sale, right, they would have lost the portion, right? And this portion will tend to increase the NCI. Increase the NCI, right? If you all mention this, right, that's an additional mark. If you all mention this, that's an additional mark. You all were at 80. After you all sold, you all went to 70, right? There was a gap of 10%. That gap was allocated to your NCI. If you all speak about that, you all will be able to get another 1 mark, right? It's quite simple. Okay? Quite simple. It's quite simple. Okay? Then after that, then after that, then after that. Then after that, let me move on to the calculations, and after that, I'll come into 1.3 and 1.4. That would be best. That would be best. Okay, that would be best. These 2 points I know now for now that you all will be able to handle now because I have given you all the needed information, right? I have given you all the important information that is needed. You all be able to handle. Okay. So after, let us jump into the calculation. Let us jump into the calculation, right? Step one is, what you all need to do is, see, you all need to show after the disposal, right? After the disposal, at the reporting date, year end, how much is your investment in straight line? or Starlight, right? You all need to show at 30th or 31st April, right? 31st March 2006. What is your what is your net assets value? What is your net assets value? What is your net assets value? So what y'all do? Y'all take all the net assets that's available within your company. Then you'll take all your net assets. Let us start off with our share capital. Let us start off with our share capital. Our share capital they told, right? We did not go and issue after 1st of April. We did not go and issue any number of shares. So that will remain at 1 million, right? That would remain at 1 million, right? We did not go and issue any number of shares, right? Goodwill on 1st April 2002 was 320,000, right? And after that, there was an impairment of 15% on 2004, right? And after there was nothing. We did not go and acquire anything. We did not go and sell anything, right? Goodwill remain as it is. Goodwill remain as it is until 1st January 2006, right? Until 1st January 2006. So how much goodwill will be? How much would be goodwill will be? 320,000. Sorry, 320,000 would have been on 2002. After your move, after 2 years to 2004, right? You all had an impairment by 15%. So that is you all need to calculate at 85%, right? Which would give you all 272,000 goodwill. Okay. So at 31st third, your goodwill would be 272,000. 272,000. Here's the workings. Here's the workings. Okay. Here's the workings. Okay. Here's the workings. Goodwill will be 272,000, right? Now see, why am I calculating net assets is because I disposed it, right? When you all are disposing, you all need to calculate net assets. You all need to calculate net assets. Okay. You all need to calculate something called a net asset. This is part of your format, right? This is part of your format when you all are in control to control, or when you all are from 80%, right, to 70%, right? This is what I mean. You all are still in control. That is why I'm calculating something called as net asset, right? This is why I'm calculating something called as net asset, right? Okay. So you all will be able to tackle share capital and goodwill, right? And also hopefully I'll remember, right? There was an upward adjustment of 200,000, right? There was an upward adjustment of 200,000, right? What would your upward adjustment do, right? It would go and increase your land, debit your PPE, and credit goodwill, right? Why would it credit goodwill? Because your goodwill will need to reduce in terms of net assets, right? You all know how goodwill is calculated, right? Total consideration minus net assets. So when your net assets are increasing, when your net assets are increasing, it will eventually reduce your goodwill. It will eventually reduce your goodwill. You are going to, rewrite the formulas. You all will be able to understand. When your net assets are increasing in one point, right, your goodwill will be reducing. Okay, that is why I have gone and put this particular thing here. Okay, the double entries. And after I mentioned the point here, right, since it's non-depreciated land, there will be no impact to P&L, right? Non-depreciated. I've mentioned that also. If you all want, you all can read it. Otherwise, no need at all. Okay. So what we are trying to do is, guys, what we are trying to do is simple. We are trying to bring all the reserves. We are trying to bring all the reserves, right, at 31st third 2006, or we are trying to bring all the reserves to 31st third 2006, because that was what the question required us to do. That was what the question required us to do, right? They want us to, after the date of disposal, right? After disposal, how much is your value of investment was asked, right? That is why I am bringing it like this. That is why I am bringing it like this. Okay. That is why I'm bringing it like this. Okay. Now, I guess I'll need to read again. Now, I guess I'll need to read again. The only reserve, the only reserve within equity of individual statements, right, is the retained earnings, right? The retained earnings on 1st April 2005 was 4.658 million, right? On 1st April 2005. So I get this would have been your previous financial year. Previous financial year. Okay. Your previous financial year would be 4.658 million, right? 4.658 million. You all know, right? Retained earnings is not for a year. Retained earnings is a cumulative basis. Retained earnings works on cumulative basis, right? Retained earnings works on cumulative basis. So on 1st April 2005, 1st April 2005, we would have had 4.658 million, right? After that, let me read on again. The profit for the year ended. The profit for the year ended. What does he mean? The current year profits. The current year profits are 165,056, right? Which is accrued evenly. What does he try to say? What does the examiner try to say? What does the examiner try to say by this? Right? This 165,006 is for the current financial year. Fine, no problem. No problem. Is for the current financial year. My question to you all would be is, do I need to go and show off this entire 165,056, or do I need to calculate this until my date of disposal? Is my question, right? My question is simple. Do I need to show this 165,056, right, as retained earnings, or as an addition to my retained earnings? Do I need to show this as a profit, or only will I take the profit until 1st January 2006? Do I need to take the profit until 31st March, or do I need to take the profit until 1st January 2006? Is my question to you all. Exactly. Obviously, 166, 165,056 would have been your entire profits, right? But you all sold the investment on 1st January 2006. Yes, I know. Yes, I know. You all did not sell the entire 80%, but you all sold 10% of it, right? You all sold 10% of it. So, you all what you all need to do is, you all need to show 165,056, right? Divided by 12 months will give you all profit per month, right? Will give you all profit per month. From 1st April 2005 to 1st January 2006, that would be April, May, June, July, August, September, October, November, December. It would give you all 9 months. It would give you all 9 months, right? So the profits that you all need to show for 9 months would be, only 123,792, right? So this you all can, you all can separately show, or you all can include it under your retained earnings, right? So what your retained earnings would be, you all need to show is retained earnings at the date of 31st 3rd 2006 would be 4.658 plus 123,792, right? But for your explanation, or for my explanation and for your understanding, I broke down into two, right? I broke down into two. Apart from that, retained earnings and profits are in the same reserve, right? This is all it. This is all it. This is all it. This is all it. Share capital, no change. Goodwill had a change because they forgot to do 15% impairment, right? So at the date of 31st third, or at the reporting date, goodwill would be 272,000 after impairment. There was an upward adjustment where none of us or none of the examiner has gone and done that adjustment. So we had to bring that also into our net asset calculation, right? We need to bring that also into our net asset calculation, right? Later on, later on, and last, we are left out with our very last reserve, which is our retained earnings, right? The reason why I broke your profit for 9 months is, see, again, I'm repeating, from 1st April 2005, I had 4.658, right? I had 4.658 million. I had the profits or retained earnings, right? Which is accumulated. From 2002 to 2005, it was 4.658. But after that, for the current year, I had a profit of 165,056, right? But I sold off, right? I sold off 10%. I sold off 10% on 1st January 2006. So I need to show that impact. I need to show that impact. If I don't show that impact, my accounts are going to be wrong, right? That is why I showed these profits are only until 9 months. You see, profits are only for 9 months. Profits are only for 9 months, right? If you all show that, you all will be able to get something, or you all will be able to get something, calculate something that is called as, right? You all will be able to calculate something called as net asset at the date of disposal, right? Net asset at the date of disposal. Okay. That would be net asset at the date of disposal would be all these in addition. All these in addition. Right? All these in addition. Okay. All this is in addition. So net assets at the date of disposal would be simple. It would be 6.253,792,000, right? This would be your net asset at the date of disposal. Net asset at the date of disposal would be 6.2 million, right? The summation of all this, right? And you all need to calculate something that is called as increase in NCI, right? I told that, right? That 10% I need to allocate it to a particular person. That particular person was initially 20%. After it, he moved on to 30%, right? So that would be from your net assets, your NCI will have an increase of 10%. Your NCI will have an increase of 10%. How much do you all need to give for NCI now? From your net assets, you all need to give an additional amount of $625,379. Right? This you all need to tell. Right? This you all need to tell. This you all need to tell. Right? If you all need the double entry, right? If you all need the double entry, what happens is you all sold 100,000, right? You all sold off 100,000, right? You all sold off 100,000. Okay. You all sold off 100,000 for $7 per share. How much did you all sell at? You all sold it for 700,000, right? You all sold it for 700,000. Okay. How much was your increase in NCI? How much was your increase in NCI? Now you all will be knowing, now by looking at this, you all will be knowing why did I calculate this particular NCI? Why did I calculate this increase in NCI? You all will be knowing, right? Because any difference, can you all see here? This person is at 700,000. This person is increase in NCI, right? NCI is an equity component, right? NCI is part of equity. So if it increases, it's a credit, right? If it cannot see the difference between 700,000 and 625,000, any difference needs to be transferred into a reserve called other component of equity, right? You all need to transfer this into other components of equity, right? That is why I've told you. That is why I've told you. You see, any difference between the cash proceeds, right? Any difference between the cash proceeds and the increase in NCI needs to be transferred to other components of other component of equity reserve, right? How much will you be transferring? You can include the calculations. You will be transferring 74,620, right? This is it. This is it. This is it. Okay. This is it. Okay. Now, for most of y'all might be thinking, why did I go and calculate increase in NCI? Because obviously, when y'all never sold the entire stake, right? Y'all never sold 80% entirely. Y'all did not sell 80% entirely. Y'all only sold 10% of it, right? Because the parents sold 10%, because the parents sold 10%, that 10% had to be allocated. That 10% had to be allocated to a person known as NCI, right? NCI was initially at 20%. He went up to 30% because of that, right? Obvious, and also you all know, right? When this happens, when this particular thing happens, right? You all need to give your net assets. You all need to give your net assets. Initially, you all were giving at 20%. So this would have been initially at 20%, right? But after that, now, because of the additional 10% increase, right? Because of the additional 10% increase, you all need to give. You all need to give in addition to 20%, right? You need to give 10% more to NCI, right? This is what is happening. This is what is happening. Earlier, I gave net assets at 20%. Earlier, I gave net assets at 20%. But now, you all need to give him another 10% more, right? Another 10% more. How much will you give him? 625,375. So $379 are needed to be given to your NCI from your sales proceeds. From your sales proceeds. The remaining, the remaining will be stored in our other components of equity, right? This will be stored in this particular reserve, right? This will be stored in our particular reserve. We sold, let me again repeat it. We sold it for 700,000, right? We sold it for 700,000, the 100,000 shares, right? We gave off, we had to give because why? There was an increase in NCI, right? There was an increase in NCI. Because of that, I had to pay out of my net assets. I had to pay out of my net assets 625,379, right? I paid it off. And after that, what the entire company is remaining, or what the entire company is left off with, but the entire company is left off with is only this particular amount, which is to be transferred to other components in equity, right? This is all you need to know in terms of that, right? This is all you need to know in terms of your calculations. Okay. It's all you need to know in terms of your calculation. Okay. And for other people who might be asking, why am I calculating net assets? Why am I calculating net assets? See, it was simple. The reason I calculated net assets is because they want me to show at the reporting date, which is 31st March 2006, how much is my share capital? How much is my goodwill after impairment? Right? How much was my share capital? Right? Share capital did not have any other this ones, right? It did not have any other share issues, right? How much was my upward adjustment or revaluation reserve? My revaluation reserve was now at the date of reporting date, it's 200,000. How much is my retained earnings? How much is my retained earnings? My retained earnings would be 4.658 million plus the 9 months profit would give me a total net asset at the disposal date. Right? This is what they need. This is what we need to include. Right? This is what you all need to include. And you all could conclude with a very last point. You all could conclude with a very last point. Hopefully, I'll remember. Hopefully, I'll remember. Right? Hopefully, I'll remember. We spoke about NCI, right? We can speak. We can conclude that point as well, right? We can conclude that point as well. Earlier, see this NCI is at fair value. Okay, this NCI is at fair value. That means early y'all would have been allocating. Early y'all would have been allocating the impairment at 80 is to 20, right? Early y'all would have been allocating the impairment at 80 is to 20. Right, let me include that. Earlier impairment, right? 80% for parent, 20% for uh, NCI. But now what happens? Now what happens? Now what happens is that impairment will be allocated for parent at 70%, right? And for NCI, you will only allocate now at 30%, right? If you all speak about this, you all will be able to get another 1 mark. If you all speak about this, you all will be able to get another 1 mark. Right? If you all speak about this, you all will be able to get another 1 mark. This is what I have mentioned here. This is what I have mentioned here. Right? This is what I mentioned here. Here, see, in terms of goodwill, since they are valued at fair value, obviously you all know goodwill is valued at fair value, right? And due to the increase in NCI at 10%, we need to reallocate. We need to reallocate the proportion of goodwill properly, or I would say impairment. Right? We all need to allocate, even though the standard does not specifically mention. Go and read IFRS 10. Go and read IFRS 10. IFRS 10 has not specifically mentioned, right? What do we do when there is an increase in NCI, right? IFRS 10, which is control, that control standard has not told us what to do when there is increase in NCI, right? That is what I have mentioned here. That is what I have mentioned here. Okay. If you all include all this, right? If you all include all this, is more than enough. Is more than enough. Right? It's more than enough. Okay. This is more than enough. Okay. Now I need to check. Now I need to check. Have you all understood this? Have you all understood what we went through? Take your time. It's 11:42. Take your time. About 3 minutes. I'll give you all. If you all have any doubts, you all can ask. Okay. So I'll give you all again a summary. Right? I'll give you a summary. Let me tell it as a story. Okay. I'm going to tell it as a story for 3 minutes. Okay. So first, what happened? You all had 80%. After it, you all sold off 10%. Right? And at the date, you all only had 70%. You all need to ask from yourselves, did you all lose control or not? In this case, you all did not lose control. So that's why you can again, you can start continuing to do consolidation of PNL. In case if you all have lost control, right, you all need to stop consolidation, right? That is what I have mentioned this particular point, right? After that, that 10%, now coming here, that 10%, for who will it be allocated? That 10%, earlier NCI was 20% and parents was 80%. But after the disposal, our parent share would reduce, right? Our parent share would reduce. And who do we need to give it back? Who do we need to give it back? We will send that to non-controlling interest. Why we need to send it to non-controlling interest? That is what I mentioned in 1.2, right? The increase in NCI, right? After that, I moved on to my calculation. After that, I moved on to my calculation. What did I do in calculation? Right? Because I did not lose control, right? Because this was a control to control situation. Because this is a control to control situation, you are needed to find, you are needed to find, right? You are needed to find something known as net assets at the date of disposal. You all are needed to find net assets at the date of disposal, right? Your share capital did not move. Your share capital did not move. Goodwill also did not move except for the impairment, which was done in 2004, right? There was an upward adjustment. Yeah, there was an upward adjustment that is in terms of your revaluation reserve, right? This is going into your share capital reserve, right? And your retained earnings, right? Your retained earnings would be a tricky part if you all did not time apportion, right? As at 2005, your cumulative retained earning balance would have been 4.658 million, right? And after that, you all got the profit for the period, but you all do not need to go and mention that entire profits. Why? You all are selling off you all are selling off your 10% on 1st January 2006. So because you all sold, you all only need to time a portion only for 9 months your profit. After that, you all will be coming up with something known as net assets at the date of disposal, right? Which is 6.253, right? And now you all need to find out something known as increase in NCI. Why? Earlier, net asset you all only gave for the NCI at 20% earlier, right? Earlier, you only gave the NCI at 20%. Now you all need to give additionally, you all need to give 10%, right? You all need to give an addition of 10% to NCI, right? You all need to give an addition of 10% to NCI, right? In addition to the 20% you all gave earlier, you all need to give an addition of 10% in NCI, your net assets, right? That would be 625,000. Okay. You all sold off. Finally, what y'all did was y'all sold off the shares, 100,000 shares, y'all sold it off for 700,000, right? Because of that additional increase in NCI, y'all had an outflow. Y'all had an outflow of 625,379.20. What is left off with the company is only 74,620. That is to be transferred to the company's reserve, which is known as other components of equity, right? This is all that is to be done in terms of this particular question, right? Is all that is to be done in this particular question, right? That is what I've told. Any difference between cash proceeds, that is 700,000, and the increase in NCI, you all need to calculate something called as increase in NCI, right? That is why we are doing that net asset calculation, right? Right? Will be transferred to other components of equity, right? This is it, guys. This is it in terms of your first question. This is it in terms of your very first question. Okay, this is it in terms of your very first question. If you all have any doubts further than this, I mean more than this, if you all have any doubts, what you all could do is after class, right? I'll extend the session, right? You all could ask me. You all could ask me. That would be best. You all could ask me. No problem. We can stay for a bit more and we can clear your doubts, right? Now, we are moving on to our second requirement. We are moving on to our second requirement. This of course, this of course, IFRS 15, right? This of course only needs a concept of IFRS 15 and basic financial accounts, right? This of course, I guess you all can discuss. I'll always just give you pointers. Discuss the principles, okay, that is needed to be when you're recording sale of goods, right? They have gone and sold some goods. They have gone and sold some goods. We need to show how does it impact the individual financial statements, right? We need to show how does it impact the individual financial statements, right? They are not speaking about group. They are not speaking about group. This is quite basic. They are only asking, they have gone and sold some goods. How do you record that goods in your individual financial statements is what they're asking. This is basic accounting. This is basic accounting, right? This is basic accounting. You all need to show how do you all go and treat that revenue in your individual financial statements. Why? You all sold some goods, right? And also let me put a star here. Also, let me put a star here. They want you to conclude. I'm using another pen. I'm using another pen. They want to conclude on whether the accounting treatment is correct or wrong. So I guess these examiner would have done some treatment. This examiner would have done some accounting treatment. We need to advise whether it's correct or wrong, right? If you all advise, you all will be able to get 1 mark. Okay. So I'll soon jump on. Let me soon jump on here. See, if you all conclude, you all will get 1 mark. If you all do calculations, you all will get 1 mark. And if you all explain, you all will get a maximum of 4 marks. So 4 plus your conclusion 1 and 1 mark for your calculation would give you all 6 marks in total, right? If that is so, if that is so, if that is so, what do I explain in my individual financial statements? What do I explain in my individual financial statements and what do I conclude if they are correct or not, right? So that I will need to read this paragraph. For that, I will need to read this paragraph of my second question, right? On 20th March, obviously that's next year reporting date, right? Your reporting date is 31st March. Luna Core sold 5,000 units. He also sold 5,000 units at $200, right? He also sold 5,000 units at 200. So how much would it be? How much would it be? 5,000 into 200 would give you 1 million. Right? It would give you 1 million. Would give you 1 million. Right? Now can you see here? And the control of good is passed. Let me use another pen. Now then. Can you see here? And the control of the good is passed. When you look or when you have a feeling, right? When you have a feeling, right? This should ring bells. This should ring alarm, right? Control of good pass. Control of good pass. What is he trying to mean? What is he trying to mean? What is he trying to mean? Right? He's trying to bring in IFRS 15. Hopefully, remember. Hopefully, remember IFRS 15. You all only need to recognize revenue when your control is passed, when the ownership is transferred, when you all receive cash, right? Or when the risks and rewards are being transferred. So this is an indication. This is an indication of IFRS 15. Okay? Be alert. Be alert. No problem. Be alert. Right? On that day. Payment is only due when Starlight Co sells the goods to the end customer, which is typically takes around 6 months. Right? Okay. Okay. Starlight Co has not sold any goods to the final customer as of 31st March 2006. Right? Okay. Let me go and write some general points and come. Let me go and write some general points. Okay, my first general point would be I have identified this to be IFRS 15, right? Why that control was an indicator, right? So I'll write about IFRS 15. What will I write? So I will only record in the books when the control or purchase obligation, a performance obligation is transferred, right? You all need to mention that. IFRS 15 says when your performance obligation is met or when the control is transferred only, you all need to show as revenue. If you all mention that, that will give you all 1 mark, right? And also, revenue will not be recognized. This was an additional mark. I mean, sorry, this was an additional point that I wrote. Why I wrote is, can you all see here? That examiner told about something like, say this case, examiner spoke about uh, payment is only due when Starlight Co sells the goods, right? Based on that point, I created an answer. Based on that point, I created an answer. How did my answer I create is, see, normally there are people who record revenue when you receive cash. right? They would wait until you all receive cash. That is totally wrong, guys. That is totally wrong. Revenue is supposed to be recognized. Revenue is supposed to be recognized when your purchase or when your performance obligation is met, right? You all don't record revenue until your cash is received, right? That is when you all do accounts in terms of cash basis, right? But you all are doing accounts in terms of accrual basis, right? What does accrual say? Whether you receive cash or not, right? You need to record revenue. That's what I mentioned here. Revenue will not be recognized when the payment is received, since SOPL is on accrual basis, right? This is an additional point that I looked at this particular thing, right? And I was able to identify, right? Don't worry, don't worry. So once y'all get familiar with this, y'all will be able to do this. Don't worry, right? Once you get familiar with this, y'all will be able to do this. Okay. And also, this will be recorded at a point of time, right? When do I need to record this revenue? Since it's a good, right? Once I transfer my Apple phone, right? From that day, that Apple phone is yours, right? I'm the seller, you're the buyer. I'm transferring you an Apple phone, right? From that day, that Apple is yours. That Apple phone is yours, right? That iPhone is yours. So this is you will be recording at a point of time, right? How do I determine? Because the possession is transferred, okay, or the ownership or whatever that thing, risk and rewards are transferred. Any of this, you all right, you all will be able to get 1 mark, right? You all don't need to include all these points. If you all tell the control, or I mean, you all need to record only revenue when the performance obligation is met, you will be able to get more mark. And if you all tell when do you all need to record revenue, is it at a point or over the time, right? If you all tell that, you all will be able to get 1 mark, total 1 mark, right? For both of this, 1 mark you will be able to get, right? For this, totally I will be able to get 1 mark. Okay. I mean, this particular part, if you all like, you all can write. Otherwise, you all can avoid this revenue that will be recognized on a accrual basis, right? That you all can write if you all feel that is needed, right? If you all feel that is needed. Okay. The goods have high risk of obsolescence, right? What does this mean? There is high damage, high level of damage, high level of damage, right? High level of damage. Okay, high level of damage. Okay. Therefore, you need to give price concessions. Price concessions means another name is discounts. Obviously, right? No one would like to buy the damaged goods at the same markup price, right? They all need to give discounts, right? Right? Okay. Or regular transfer can be easily transferred within the distribution channel. On the past practice, right? So past practice means like based on the historical records. Based on the historical records, right? There would be a concession between 8 to 38%. I mean, normally the discount rates would vary from 8% to 38%. Discount rates would vary, right? But the current market data suggests that the maximum amount of discount or concession would be only 35%, right? Would only be 35%. Now, what you all need to know, what you all need to know, well, this is a new one. This is a new one, right? This is a bit you all need to, you all need to alert your minds. You all need to alert your minds. See, can revenue figure be identified? Right? You all need to ask this question. You all need to ask this question. Right? You all need to ask this. Now, see, you all are going to record revenue, right? You all need to record it at a dollar figure. You all need to record it at a dollar figure. You all need to record it at dollar figure. What would that figure be? What would that figure be? Now, guys, don't go and tell me that you all will be recording at $200, right? $200 is before concession. Okay, $200 is before concession, right? $200 is before concession, right? I need to give, y'all need to give me a figure after concession, right? After concession or after the discount, how much do I need to record it at? After the discount, how much do I need to record it at? I will not be recording at 200. Again, I'm repeating myself, right? I'm not going to record it at 200. I'm not going to record my revenue at 200. It would be at a lesser amount because there is a risk of obsolescence or damage. Because of the damage, I need to give discounts, right? So how much would the amount be? How much would the amount be? How much would the amount be? Okay, let us come. Okay, so most of you all would not know. No problem. No problem at all. This is your very first time, right? So let me give you all a learning. Let me give you all some a learning tip. Let me give you all a learning tip. So what this learning tip would be, this is a variable consideration. You all would have studied in FR what is a variable consideration. Variable consideration means here it is, guys. Here see. Due to the obsolescence, can I determine the market value? No, right? I mean, obviously, yes, the market value is 200 rupees or $200, but that is before the discount. That is before the discount. It is not after discount, right? So that is what you need to mention. Due to the obsolescence, the fair value of the good cannot be determined. Therefore, this will be known as a variable consideration, right? Don't worry. I'm going to now explain what is variable consideration again, or I'm going to recall for most of y'all who have forgotten what is variable consideration, right? Why do I need to tell this is variable reconsideration? Because y'all are uncertain of the amount. Y'all are uncertain of the amount, right? Can y'all tell it's 200? No, right? Y'all can tell it's 200 at a rate of after deduction of 8% discount or after deduction of 38% of discount or after deduction of 35% of discount, right? Can you see this discount rate lingers between discount is between, it can be 8% y'all can get discount, right? Y'all can get at 30% discount, 38% discount, and also y'all can get at 35%. So now because of this, y'all are not sure which discount rates to use. Y'all are not sure which discount rates to use, right? Y'all can use the past practice discount rates or y'all can use the current market data discounting rates, right? That is why I'm telling this is a variable consideration, right? I don't know what is the selling price I'm supposed to take. I don't know what is the selling price I'm supposed to take. Why? Because my discount rates are in different percentages. It is 8%, 38%, 35%. So I'm not aware of what percentage to take, right? Because of that, there is an uncertainty, right? There's an uncertainty, right? Or something known as variability, all right? If this 200 rupees or if this $200 was remaining constant, right, after the obsolescence, I would call that as fixed consideration. But this is not fixed consideration. This is something called as variable consideration. It has a high level of uncertainty because of these discounting factors, because of these discounts or concessions being given, right? So only now I need to write off. Now I need to write off. I need to write off. I need to find out what's the selling price, right? I need to find out what is the selling price, right? For that, you all need to know variable consideration. You all need to know variable consideration. I'll soon give you all some hints or tips, right? Variable consideration tips. I know I'm going beyond my time, but I need you all to understand very well. I don't want you all to get puzzled in the exams, right? First of all, why? First of all, why does a variable consideration happen? Because there's a high level of uncertainty. High level of uncertainty, right? There's a high level of uncertainty. Okay, that is why a variable consideration happens. Okay, variable consideration has two conditions, right? two conditions, right? One condition here are there. You all need to satisfy these two conditions, right? These are the two conditions, guys. These are the two conditions, right? These are the two conditions. Here it is, right? These are the two conditions. Okay. What does the condition number one say? What does the condition number one say? The condition number one says your revenue must be highly probable, right? Your revenue must be highly probable. It should not be at 50%, it should not be at 40%. No, it should be at 95%. That is about, like, it's about certain, right? Your revenue is certain. It will happen, right? It will happen, right? And if your revenue is probable, there should not be any significant reversal in future, right? You all can't say, no, 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 I picked up the wrong rates. I picked up the wrong picked up the wrong discounting rates, so I need to go and reverse it back. No, that is not at all. Because why? Already it's uncertainty, right? Already we are dealing with uncertainty, right? So we need to select the best probable rate, right? Because of we choose, after we choose, we cannot do any reversals. Why? We are using our best estimate. Why? We are using our best estimate. We are using our best estimate. That is why we are using the higher probable chance. We are using the higher probable chance. Okay. We are using the highest probable chance. And because of that, because we use the highest probable revenue figure, right? We do not go and again reverse it. We do not go and reverse it, right? Just imagine, guys, just imagine if you all show a revenue figure and after 1 year you all say, no, 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 that was based on a wrong estimate, that was based on a wrong assumption. Now I need to go and reverse it, right? I need to go and reverse it. How would the stakeholders, how would the shareholders believe you all, right? How would the shareholders believe you all, right? See what kind of problems you all are making. Today all are telling it's 100,000. Tomorrow you are telling no, 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 it's not 100,000. I need to reverse it. They would not believe. Shareholders would not believe you all at all, right? So you all need to tell this also. You all need to speak about this. There is a high probability. Okay, you all need to use the highest probable revenue figure, right? And there should not be any significant reversal, right? This is the condition. This is the condition of variable returns. This is the condition of variable consideration. Okay. You all can go and read IFRS 15, right? IFRS 15 under considerations, they have split a lot of considerations, right? I have given my recordings as well. Go and read, watch that as well, right? You all will be able to know what are these two conditions. You all don't need to memorize. If you all understand the concept, it's more than enough, right? Always use the highest probable revenue figure so that you all don't need to incur any significant reversal. If you all remember in whatever ways you all want, you all need, you all can get. Now, what is the accounting? What is the accounting? How do you all account it? How do you all account it? Right? How do you all account? You all can use the best estimate, right? You all can use the best estimate, right? You all can use the best estimate, which is known as expected model, right? You all can use something known as the expected model. You all would have done expected model in management accounting, performance measurement, financial report, financial measurement. You all would have done, right? Expected model, or or you all can use something known as the most likely out. Right here it is. I mentioned here. If I'm using, so this is all you all need to know in terms of variable consideration, right? You all need to know this in terms of variable consideration. If it's a variable consideration, right, it's all because of my uncertainty. Because of that, I need to mention the conditions that needs to be met, right? And the accounting treatment. I can use my expected model, right? Expected model, which will be full of probabilities, or I can use my most likely outcome, right? I can use my most likely outcome. If you are mentioned until here, this will give you all 3 marks. This 3 marks is simply theory. These 3 marks is simply theory. You all don't, if you all had memorized IFRS 15 also, you all be able to get this, right? I did not go and relate it. I did not go and relate it to any of these paragraphs. This was merely IFRS 15 theory, right? This was simply IFRS 15 theory. Okay, here comes the calculation part. Here comes the calculation part. Here comes the calculation part. Okay. Here comes the calculation part. Right. Can you see this 1, 2, 3? These 3 points are IFRS 15's theory. So if you all had read it or if you all have gone through my videos, right, through the lectures that has been uploaded, right, you all will be able to write it. Right. Or there might be people who have gone through the lectures, but they are confused on what are they like, how are they supposed to structure the answers. Well, this is it. You all write general principles, you all will be able to get 3 marks, right? You all will be able to get 3 marks. Now we are all left out with our calculations only. We are left out with calculations only, right? We are left out with calculations only. Okay, so based on the past practice, right, based on the past practice, right, they have given us a threshold. They have given us a threshold. It can be between 8 to 38, right? Obviously, you all know, guys. Obviously, you all know. When there is a threshold given, you all can use expected model, right? Or average model, right? You all can use something known as average or expected model, right? Because obviously, right, they have given us a threshold. They have given us threshold. Because of the threshold, we can use something known as average model or expected value model, right? If you all use that, right? Obviously, 8 plus 38, 8 plus 38 will give you all 46. 46 divided by 2 to get the average. 46 divided by 2 would give you all 23%, right? It would give you all 23%. So the discount rate based on past practice would be, here see, 5,000 units. Before the discount would be 200. After the discount would be 100 minus 23 would give you 77%, right? 200 at 77 would give you, you all will be recording revenue at 770,000, right? This is based on past practice, right? This is based on past practice. But if you all go and base it on market data, current market data, here it is, here it is, here it is. However, based on market data, the maximum amount that y'all could give as discount is 35%, right? Maximum amount that y'all could give as discount is 35%, right? So your revenue will be recorded at 5,000 units is sold, 5,000 units. Before the discount were 200. The maximum amount of discount that y'all could give is only 35%. So 200 into 65% would be 650,000, right? 650,000, right? 650,000, right? This is on my past practice. This is on my current market data. Now, out of this, out of 650,000 and 770,000, what do you all feel is the correct one? What do you all feel is the correct one? Do I need to go based on my past practice or do I need to go based on my current market data? Do I need to go based on my past practice or do I need to go based on my current market data? Well, ideally, I mean, since this is the very first time, right, I'll help you out. Don't worry, I'm here to help you all out. You all need to go based on the current market data. The reason why you all need to go in the current market data is, see, past practices, they are ancient, right? They are simply historical figures. You all cannot base discounts based on historical figures. right? You all need to base discounts on your current price or current figures. The reason is here, see, a maximum you all could give only for 35%, right? You all cannot go and give at 38%. So always understand, right? Always understand discounts are given at discount is given at current data rather than past historical data, right? This you all need to know. Because why you all need to know? Why you all need to know is quite simple. Why you all need to know is the simple reason is you all will be having a confusion. Do I need to record it as 650,000 or do I need to record it as 770,000? Right? I would say you all need to record it as 650,000. The reason is because 650,000 has it at current data, right? 650,000 is as current terms. It's at current terms rather than past terms. It is at current terms rather than past terms. That is why I am using 650,000 as my figures, right? That is why I'm using 650,000, right? Because this is on past practice and I cannot again go and reverse it back, right? Here it is again. If I choose past practice, I cannot go and reverse. Why? This will create significant reversal, which is against the variable consideration, right? Obviously, if I go and choose past data and suppose those past data are inappropriate, right? And after that, I go and I because of that I need to reverse it, right? It will create something called significant reversal or major reversal, right? Which is totally against my variable consideration model, right? It is totally against. Right? That is why I'm stressing on again and again, right? Obviously, you will be having a confusion. Should I record it as 770,000 or 650,000? The best is to record on your present data rather than the past data. Why? When you all used past data, suppose if those are on wrong, those are calculated wrong, right? You all will be having to do a significant reversal, right? The standard says, or the condition of variable consideration says, I don't want to have any significant reversal. So use, right? So use the best estimate. Use the best estimate. Where can you find the best estimate? If you use the current market data, right? You find best estimate only with current market data, right? I have given you all multiple. I don't know why am I giving you all, right? Because I feel that you all might be needing this, right? You all only can get the best estimate using the current terms, right? No one would, I mean, simply, right? No one would simply go and invest in a share market based on past records, right? I mean, yes, they do until a certain extent, but the majority will be focusing on the future, right? So that's what you need to record it as 650,000, right? And the final one, guys, final one, we need to conclude whether they are correct or wrong. Whether they are correct or wrong. Well, they would have been wrong. They are wrong, right? They are totally wrong. Why they are totally wrong? Why they are totally wrong? You see, Luna Co sold 5,000 units, right, at 200 per unit, right? they would have gone and recorded it at 5,000 units into 200, right? Wait, I'll show you back. Wait, I'll show you. There's Monaco sold 5,000 at an initial transaction price of 200. Here it is. Here it is. They sold 5,000 units at an initial transaction price. Okay, the initial transaction price would have been 200. Fine, no problem. But did you all, they have forgotten, right? Or have they ever mentioned about the discounts that they took into consideration? No, right? So what they would have done is they also would have gone and recorded 5,000 units at $200 per unit, right? You see, the initial transaction price is only 200. They did not take the transaction price after the discount, right? So you need to go and reverse back. You need to go and reverse back. You need to go and reverse back, right? If you are recording at 650,000 is the revenue, they have recorded at 1 million, right? They have recorded it at 1 million. Let me break that is also house is 1 million coming, right? 5,000 units into initial transaction price is 200 before discounting only. They have not taken after the discount. They have not taken after the discount. If they have taken after the discount, they would have mentioned in here that this is correct or something they would have mentioned, but they have not mentioned anything. So we need to assume that they have gone and recorded at 1 million, which is totally wrong. The ideal revenue that is supposed to be is only 650,000. So we need to reverse back. We need to reverse back 350,000 back. We need to reverse back 350,000, right? If you mention this, you will get that entire mark. If you mention this, you will get that entire mark. That entire mark is totally yours, right? They would have gone and only recorded at the initial transaction price because there's nothing mentioned whether they were correct or wrong. So under an assumption, right? Under an assumption, I'm considering, right? They would have gone and recorded and under 1 million rather than taking 200, they should have taken after discount, right? The unit price should have reduced, but these flows would have definitely taken before the deduction of discount, right? Before the deduction of discount. Okay. Okay. Right. I'm sorry. I've taken a lot of your time, but I need to stress on these points, guys, so that you all don't suffer in your final exams, right? So when you all are watching your Google Classroom lectures also, right? You all take your time, very own time, and you all can watch it at an easiest manner that you all prefer. Okay. If you all feel that this is dragging, right? If you all feel this is dragging, no problem. Put it into a fast forward format and watch it. But make sure that you all are able to grab in the important points. That is what I need, right? I'm giving you all utmost flexibility, right? You all can do whatever you want, but make sure that you are grabbing the important points, right? The last one, only just give me about 15 minutes, guys. 15 minutes is more than enough. I'll soon finish this off, right? He wants me to use exhibit 1 and 2, and he only wants me to present extracts. No discussion, simply extracts. Extracts means simple line items of how do I show it in my SOFP or SOPN, right? That should be included in my consolidated statement of profit or loss. Okay, he specifies profit or loss, right? What my answer should include, it should include group revenue, group cost of sales, and group profit attributable to MCI, right? Here, see, why am I saying group? Obviously, it's a consolidated statement of profit or loss, right? I need to include revenue, cost of sales, and profit attributed to MCI, right? What I feel is the time is getting wasted, these guys, because I also am reading on the question again so that I can mark off the important points. If you all are able to read off this question and come, right? It's matter of fact, I will just need to, mark the important points. But I would say that that would not be effective because obviously, even when my lecturers told me to read, right, I never read any of those papers, right? So I know, I know. Okay, here see, Luna co-parent, Starlight is a subsidiary, right? So consolidation, obviously, you all need to take parent plus subsidiary, right? You all need to take parent plus subsidiary. Here it is. Parent, right? This is the parent plus subsidiary. Sorry, I'm not going to do this with y'all because you all know this, right? You all know this very well. You all can do this. Okay, parent plus subsidiary. Cost of sales also the same. Parents, take the parents plus the subsidiary cost of sales, right? From that, you all need to remove unrealized. Sorry, you all need to add back unrealized profits, and you all need to remove the sales. You all need to remove intra-group sales, remove intra-group sales, then add back URP, unrealized profits, right? Obviously, you all know the intra-group sales was 1 million, right? They have gone and recorded, sorry, sorry. They have gone and recorded 1 million, right? This 1 million is totally wrong, right? So you all need to remove 1 million from your revenue as well as your, give me a minute, let me put this to charge. I need to put my laptop to charge. Sorry guys, sorry. I had to put my laptop to charge. Right. I'm almost done. I'm almost there. Right. I might be able to soon finish it off. Right. Obviously, I'll know when I look that 1 million is an intra-group sale. Right. You need to remove it from both parent and pay from the revenue and your cost of sales. Right. You will be removing. After that, you're left out with unrealized profit. How do you calculate unrealized profit? How do you calculate unrealized profit? It's quite simple. It's quite simple. Here it is. The initial cost is $80, right? And the initial selling price is 200. So profit is 200 minus 80 would give you 120, right? Would give you 120. This is how I found this 120, right? You all need to add back 120 into 5,000, right? 5,000 units you sold. 5,000 units you sold. 5,000 units you sold. So you all need to add back how much? You all need to add back only $600,000. You all need to add back $600,000. Will you all go and add it back in revenue? No, you all need to add back in cost of sales. Why? That is an unrealized profit that would have gone and increased the profit, right? This increases my profit, right? This increases my profit. If I need to reduce my profits, right? The ideal way is I need to increase my cost of sales, right? If you all do that, you all will be able to get, right? And we are left out with the very last one, right? We are done. We are done. We are done, right? You have to copy this and you all paste it. You all will be getting this 4.2 million and 2.879 respectively, right? We are done. We are done. And last, you all are left out with something called, we are done with revenue. We are done with cost of sales. We need to show off how much the profit is attributable to NCI, right? Well, let me do that with y'all. Let me do that with y'all. Let me do that with y'all. Well, that would be here. See, can you see here? They have already given. That's what they told her. That's what they told her. That is why they told her use exhibit 1 and 2, right? For the revenue and the cost of sales, we were using exhibit 2. For profit attributable to NCI, can you see here? They gave us the profit, right? They gave us the profit. The profit for the year was 165 165,056 is the entire profit, right? How long were y'all NCI? Y'all were NCI for 20%. All right, y'all were NCI for 20% for how many months? How many months? Until 1st January, y'all were NCI, right? So that would be 9 over 12, right? That would be 9 over 12, right? until 9 over 12, I mean, for 9 months, you all would have been getting only 20% of profits, right? For 9 months, you all will be getting 20% only as profits, right? After the disposal, right? After disposal, I'll rewrite it again for after disposal. Again, 165,056 would have been your profits. But this time, you all are now at 30%. You all are now at 30% into how many months? Only for 3 months, right? Only for 3 months. Okay. All right. Because of this, by doing this, the total profit attributable would be total profit attributable is this much, right? If you all mention this, you all are going to get your entire 4 marks, right? Entire 4 marks is yours. Obviously, 1 mark is for your unrealized profit, URP, 1 mark is for removal, and 2 marks would be for your this final figure, right? Initially for 9 months, you all were at 20%. Inside was at 20%. The remaining 3 months, he's at 30%, right? So the total profit attributable is this much, right? These all that you all need to know. These all that you all need to know, right? For the people who have doubts, right, you all could stay. You all could stay. I'll drop in the new link for on your WhatsApp group, right? The remaining people, we are left out with B and C as I promised, right? Don't worry, I'll make sure that I drop in a video as very soon as possible, right? If that is so, have a very good night, right? Stay safe, right? And stay healthy. If you all have any doubts, right, as usual, contact me on WhatsApp or my mail, right? I'll be able to respond with my answers, right? Hopefully, all have understood. Hopefully, all have understood. I'm really sorry that I took much of your time, of your valuable time, right? It's because I wanted to give the importance in this particular part, which is your very first one. Okay. So see you all then in our very next session. Don't worry, the next session I would not make it lengthy. I'll somehow try to finish it off within 1 hour. Okay. Thanks a lot for joining in. Okay. See you all then.